Now, the quantity theory of money does nothing more than talk about how the money supply is related to nominal GDP, the total current priced value of economic transactions in the economy. So the quantity theory of money actually starts with something known as the equation of exchange. The equation of exchange is an identity. What it says is the amount of money that is in circulation in the economy, M, times how often that piece of money is used through the course of a year, what we call velocity. That product is equal to the price level times real GDP. Notice that the price level times real GDP is also nominal GDP. Where nominal GDP is an approximation of the transactions that take place in the economy. So velocity, this second term here, the V, is defined in a very particular way. It's the dollar value of all the transactions in the economy divided by the money supply, how big the money supply is. So basically what it's saying is how many times in the course of a year is that single $10 bill being used? Right? You're going to go down to the store and buy something with it, but then the store owner is going to do something with it, and whoever receives it from him is going to do something with it. So what we want to know is how many times does that dollar bill or $10 bill or $100 bill actually get used in the course of a year? That's all we mean by velocity. And notice that the way we define velocity here does, by definition, make the equation of exchange an identity. Now, there were three assumptions that are made to move from the equation of exchange to the quantity theory of money. The first assumption is that velocity is constant. The reason that this assumption was made is twofold. One is, this was actually a theory that's about 150 years old. So it's been around for a very long period of time. Recognizing that, the early economists who worked with this theory realized that velocity did not change very much, because velocity has to do with the pace of transactions in the economy, which has to do with the normal flow of business. How often do you go to the grocery store? How often do you go to the gasoline station? How often do you do this, that, or the other thing, right? Because that's when you'll be spending money. And that doesn't change dramatically from month to month, quarter to quarter, even year to year. The second thing that they recognized is what we call payment technologies, the different ways in which we can make payments in cash, with demand deposits, with electronics, right, with your smartphone, with Apple Pay, with PayPal, with whatever it might be. That historically, those things didn't change much at all. If you think about how transactions were being done in the 1960s versus the 1860s, you would see that there really wasn't much difference. So the fact that spending patterns did not change much, business flows, and payments technologies didn't change, it was observed from the available data that velocity was nearly constant. So as a model and a working assumption, let's just assume that velocity is constant. That's assumption number one. Now, if we do that, we can just put a bar over our V to indicate that it's a fixed level. Notice in this case, the money supply and nominal GDP must be related somehow. This is where the second assumption comes in. The second assumption is that the money supply is the exogenous variable. It was assumed to be an exogenous variable because the money supply was controlled by the central bank, or before central banks, by the government. Their issuance of coins, paper money, their regulation of financial institutions. Since the advent of central banks, the central bank has the ability through open market operations and other techniques to keep the money supply where they want it to be, at least on average over long periods of time. So with velocity constant, they could then say, if the money supply is our exogenous variable, then changes in the money supply must lead to changes in nominal GDP. So that's assumption number two. The third assumption is that has a lot to do with how real GDP changes over time. How does real GDP change over time? Well, we've already seen that. Think about our production function approach. Right? How much economic output there is depends upon total factor productivity, a production function, the amount of capital that we have, and the amount of labor that we have. So as we saw from the growth accounting formula, the economy will grow just as fast as total factor productivity and the growth rate of the labor force and the growth rate of the capital stock. Notice, the growth accounting formula doesn't say anything about the growth rate of money. It doesn't say anything about inflation. It's total factor productivity, labor, and capital. That's what determines economic output. And that's all that determines economic output. Economic output is what we call a real variable, right? It's adjusted for changes in prices. That's why we call it real, right? It's a real variable. Labor is a real variable. Capital is a real variable. In the context of the models we've developed so far, one of the things that we have seen, nominal variables, which do include the price level, do not affect real variables. Suppose the economy is in the steady state in the Solow model. Double the money supply. What happens to income per worker? What happens to the capital to labor ratio? Nothing. Money supply is not in the model, so nothing will happen. Have the inflation rate double. What happens to economic output per worker? Nothing. Inflation's not in the model. All we need to know, total factor productivity, capital labor, saving rate, depreciation rate, growth rate of the labor force. Changes in nominal variables do not affect real variables in the long run. By the way, the opposite is not true. Real variables do affect nominal variables, but nominal variables do not affect real variables. This distinction then means that we can take the economy and basically split it into two parts, the real part and the nominal part. When we do that, we are basically talking about something known as the classical dichotomy. So dichotomy is one of those funny words. Di means two, cotomy means cut in half. Real variables are not affected by nominal variables. So we can treat the nominal sector as independent of the real sector. That's a classical dichotomy. It's called classical because this notion has been around for a really long time. Now, this also means the following. Changes in velocity were assumed to be constant. The money supply was assumed to be exogenous. And real GDP is assumed to grow based on total factor productivity, the labor force, and the capital stock, independent of the money supply. In which case, changes in the money supply are going to lead directly and proportionally to changes in the price level. This latter notion here, changes in the money supply directly lead to changes in the price level, brings us to something known as the long-run neutrality of money. Previous slide. Long run is generally in parentheses because when we talk about the neutrality of money, by definition, we're talking about the long run. The long-run neutrality of money is simply a subset of the classical dichotomy. The classical dichotomy says all nominal variables will not affect real variables. The long-run neutrality of money says changes in the money supply, a nominal variable, will not affect any real variables. Now, I want to emphasize this is a long-run result. We will find, in the not-too-distant future, that's not always true in the short run. So, we can now come back with these three assumptions in mind to our modified equation of exchange. Modified in the sense that we're holding velocity constant. Now, let's turn this into growth rate terms, recognizing that the growth rate of prices, the percentage change in prices, is what we call inflation. So if we start with this last equation, substitute the growth rate of velocity equal to 0 in. Remember, we're assuming that velocity is constant. And then we do a little bit of rearrangement. We end up with inflation approximately equal to the growth rate of the money supply minus the growth rate of the economy. The growth rate of the money supply over and above the growth rate of the economy is what we end up with for inflation. You may have heard of the expression, too much money chasing too few goods, as a definition of inflation. Too much money chasing too few goods, where this difference is some positive number. The bigger the difference, the bigger the inflation. Inflation is approximately how fast the money supply is growing over and above how fast the economy is growing. So think about it. It's over and above. Notice that in a growing economy, you will also need to have a growing money supply. As the economy grows, the number of transactions or expenditures is also increasing. To facilitate those increasing transactions with a constant velocity of money would require that the money supply grow as well. By the way, one of the things that this tells you is that Bitcoin, how many of you have heard of Bitcoin? Okay, so how many of you made a purchase with Bitcoin? Okay, so this is one of the things that will tell you why Bitcoin, as it's currently designed, will never be successful as replacing national currencies. Why is that? Over time, economies grow. Bitcoin's algorithm is set up to reach a maximum number of Bitcoins after you've spent way too many hours mining for them. Right? You reach to a maximum level. And then the growth rate of the money supply becomes zero forevermore. What happens? If the economy is growing, inflation has to be negative. Prices have to go lower and lower and lower. Or velocity has to go up and up and up and up. Well, there's probably an upward limit to this velocity, and there's probably a situation in which people don't like deflation. So let's think about deflation for a minute. At one point, you're all going to graduate. You're all going to get really, really good jobs. You might want to buy a house, or you might want to buy a car, or other relatively expensive items. But you know that 6 months from now, all those really expensive items will be cheaper then than they are today. How many of you are going to wait 6 months to make your purchase? Okay, lots of you. Now, fast forward 6 months. Okay, price indeed is cheaper. But then you're told, oh, I just remembered, 6 months from now, prices are going to be lower again. So maybe I should wait before I make that purchase. And some of you won't want to wait because you need that new car. And some of you won't want to wait because you're tired of living in your parents' basement. You want your own house. So you go ahead and make that purchase. But other people will wait. And guess what? As you're waiting on your purchases, businesses don't need to make as much stuff. If they don't need to make as much stuff, what happens? They don't invest as much. Capital stock grows more slowly. The economy grows more slowly. We grind to a halt. And maybe the economy actually then becomes negative. So one needs to have a growing money supply in order to facilitate the transactions in a growing economy. Now, this last equation can also be thought of as the quantity theory of inflation rather than simply the quantity theory of money. Again, the quantity theory of inflation says the inflation rate equals the rate of growth of the money supply minus the growth rate of real economic output. Or as Milton Friedman put it, hopefully you all have heard of Milton Friedman, reasonably famous economist, very famous economist. As he said when he was working on the quantity theory, inflation is always and everywhere a monetary phenomenon. This is exactly what he had in mind. Right? You can't have inflation in the long run without the money supply growing faster than the rate of economic growth. That is a necessity. And here's a chart out of your text, which shows for the United States the rate of growth of the money supply on the horizontal axis and the inflation rate on the vertical axis by decade. And what do we see? A nice, strong, positive relationship. The faster the money supply grows, the higher the inflation rate has been over 10-year periods. And looking at it, again, across countries, money supply growth rate and inflation for a 10-year period, or maybe 11, 2002 to 2012, what do we see? Countries with the highest money growth rates also experience the highest inflation rates. So in the long run, it appears as if the quantity theory of money and the quantity theory of inflation are definitely consistent with the data that we see. But I also wanted to look at it in a more short-term sense for the United States alone, just for the last 50-some-odd years. So the blue line here is inflation using the gross domestic product price deflator, and the brown line is the money supply growth rate minus the growth rate of real GDP. And one of the things you can see is that the broad trends are there, at least up until about 2000. Yes, the money supply excess over real GDP growth is more volatile, but again, those broad trends are there, and there are even a lot of places like right in here where they all move in the same direction. But you can also see in a short-term sense, it doesn't look like a very strong relationship, even before 2000. So I said, well, this is annual data or year-on-year data. Let's look at it on a slightly longer time scale. So I took the same data and I said, let's look at this over a 5-year period, a rolling 5-year period. And notice that, again, up until about 1990, from 1964 to 1990, my goodness, that is a really, really strong correlation. And since 1990, it's sort of like, oops, the whole thing fell apart. The whole thing fell apart. What happened? Those 1980s were quite something. Well, what really happened was the velocity of money changed dramatically. So back in the 60s, 70s, we saw an average of about 1.75. It went up a little bit in the 80s to about 1.85. And then all of a sudden, we saw this big move up, and then back down, another bump up, and then down, a little bump up, and another big drop down. Notice how much it's moved since the onset of the recession at the beginning of 2008. We've gone from 2 to just over 1.5. And there's no indication that it's bottomed. That is, velocity of money may continue to fall. So now, if we want to think about the quantity theory of inflation, not only do we have to think about how fast the money supply is growing, not only do we have to think about how fast the economy is growing, but we also have to think about how fast velocity is growing. Right? We need to know what's happening to velocity as well. So that original assumption that we made, moving from the equation of exchange to the quantity theory of money, about velocity being constant, clearly is not an assumption we can make anymore. But even with that, it's really easy to adjust our quantity theory calculations to take into consideration what's happening to velocity. The most difficult part about this expanded equation is that it's very difficult to explain those changes in velocity. Some of them, we know what's causing them, but a lot of it still remains a mystery. Okay, so we know what causes inflation, at least in the long run. The money supply growing faster than the economy adjusted for changes in velocity. But we also want to think about what does inflation mean for interest rates. In here, we go back to our good buddy Irving Fisher and bring back the Fisher equation. So remember, the Fisher equation told us the relationship between nominal interest rates, real interest rates, and the expected inflation rate. Now, if we take the Fisher equation and we invoke the classical dichotomy, remember, nominal variables don't affect real variables, then the real interest rate should be unaffected by either actual inflation or expected inflation, both of which are nominal variables. So using this, we can think about the real interest rate as being fixed, determined by our saving and investment decisions. So now we can see that any changes in expected inflation should be matched pretty closely one for one with changes in the nominal interest rate. And so here we have changes in the rate, changes in the expected inflation rate. This is known as the Fisher effect. When you have high inflation, or inflation rises quickly, nominal interest rates will also be high or rise quickly. The real rate will be determined by saving and investment decisions, which are real, based on real variables. The nominal rate, though, is going to match what happens to expected inflation. Again, here's another chart that shows the nominal interest rate and the inflation rate. And what do we see? Again, another strong positive relationship. Yeah, there are a few outliers down here, but by and large, that relationship does hold. Now, I wanted to look at the data, again, for the U.S. So the blue line here is one-year interest rate, and the brown line, or orange line, is the inflation rate over the course of a year. Again, you can notice, up until 1980, these two matched pretty well. And clearly, the trend works both on the way up is on the way down. But it's also clear that starting in the early 1980s, the relationship began to weaken quite significantly. So what we can say about the Fisher effect is that it's reasonably accurate in the long run, not so much in the short run. Right? So when we move into our analysis of short-run business fluctuations after our exam next week, we'll have to keep in mind that the Fisher effect can oftentimes be overridden in the short run, but in the long run, it does seem to make a great deal of sense. One of the things that we need to think about is, why do we care about inflation? It's pretty easy to understand why we care about economic output, right? Because what we produce is also what we consume as a nation. And that has a lot to do with our economic standards of living. And it's easy to understand why we care about the unemployment rate, because it tells us how many people, or what percentage of the labor force, that could be working that aren't, and all the implications that that may have. Again, we'll see that that's much more of a short-run problem than we typically think of it in the long run. But it's not necessarily obvious as to why we think inflation is a big problem and what we should do about it. Now, whether or not inflation imposes costs on the economy